CEO of 10 Margo, Margo is the president and CEO of 1031 Corp and a certified exchange specialist with over 32 years of experience facilitating 1031 exchanges. She is a member of the Counselors of Real Estate. She's been involved in over 17,000 delayed, reverse, and improvement exchanges nationwide. She helped launch the Certified Exchange Specialist CES program, a voluntary certification and continuing ed program for those actively engaged in facilitating 1031 exchanges. She served as the founding chair and is a past president of the Federation of Exchange Accommodators, and she holds an MBA from Villanova University, and she regularly educates professionals and investors on the power of tax-deferred exchanges. So we are thrilled you're here with us today, Margo.
Thank you.
Our affiliate member is Diane Clerkin, and Diane has owned and operated Safety Net Home Inspections with her husband Patrick for 25 years. And I'm going to let you tell them a little bit more about yourself, Diane. Thanks.
Thank you. Good afternoon, everyone. Yes, my name is Diane Clerkin. You might know us. Our first 20 plus years were as part of a Housemaster franchise. We are now an independent home inspection company. And again, we're 25 years in business. Our inspectors are very experienced, non-inflammatory. Our approach is always education, information, a lot of hand-holding. We love working with first-time home buyers. We actually love working with new realtors who are unfamiliar with the home inspection process. It's just a lot of education information. We are state certified to do radon testing, wood destroying insect inspections. We also do mold and air quality as well as well water testing. We do try to make it one-stop shopping. We really emphasize our customer service approach, and that's not just to our buyers and sellers, but also to our realtor referral sources. We try to make your life less complicated. We take care of all the scheduling, all the logistics, all the communication between listing agent, home buyer, and home seller if necessary. There's a reason we've been in business for 25 years. We really do emphasize that quality customer experience. We do inspections 7 days a week. We work around everybody's schedule. And again, our inspectors are decades of experience and really excel at what they do. I'm going to put our company contact information in the chat. So if you have any questions, please feel free to reach out to me directly. And I'll have our email, our phone number, and our website as well. Thank you.
Thank you, Diane. We appreciate your support, and I'm going to turn it over to you now, Margo. Thanks.
Great, thank you. And I am just going to share my screen with everyone. Thank you for joining us today. I know that there's lots of things you could be doing on a pretty sunny day, so thanks for joining us. So again, I'm Margo McDonnell with 1031 Corp, and hopefully some of you are familiar with 1031 exchanges, but if not, that's okay, because I am going to make sure that when you disconnect later on, you know exactly what they are and you feel comfortable bringing up the idea of a 1031 exchange to your client. Our goal in the next hour is just to provide a brief overview of 1031 exchanges. We are going to discuss the tax benefits of doing a 1031 exchange, as well as a lot of the non-tax benefits of doing a 1031 exchange. We're going to do a brief overview of the requirements of a successful exchange, the role of the qualified intermediary. That's the role I normally play in the transaction. And we'll go through a case study or two so you can see how the 1031 exchange works in real life, and it will also give you some ideas of how it could help some of your clients. And at the end, I'll give you a couple of tips on how you could use 1031 as a sales tool. If you have any questions, like Lisa said, you can drop them into the chat. I'll try to pay attention to that, but we'll also do some Q&A at the end. And I just want to make sure that everyone has all of their questions answered by the end. And I will send the slides over to Lisa so that she can email them out to you as well. Let me get back to here. So let's get started. What exactly is a 1031 exchange? Well, it gets its name from Section 1031 of the Internal Revenue Code that provides that no gain or loss will be recognized on the exchange of real property held for business use or investment. Simply put, it is the way for the seller of any type of business use or investment property to defer the gain when they're selling one and buying another one. It's really just like the sale of one property followed by the purchase of another, except it's linked by all of that 1031 exchange documentation and completed within the necessary time frames. The whole idea behind 1031 is continuity of investment. So just assume you have a property and it's worth $100,000, and we'll assume it's a single family rental. It's worth $100,000 and you owe $30,000 to the bank. So you have $70,000 of equity. Well, the rules say as long as you buy another property and it's worth at least $100,000 and you reinvest your $70,000 of equity, you have simply shifted everything from property A to property B. No money went in your pocket, so why should you have to pay the taxes right now? IRS doesn't really care about property A or property B. What they care about is that underlying investment, that $100,000 real estate, or real estate valued at $100,000 and $70,000 of equity. And it is a great way for investors to build wealth, preserve their equity. And it seems odd that they let us do that, but let's think of something that's very similar. Let's think about our retirement accounts. And you get to open your statement up anytime to log on to the website, open it up, or open it up the mail statement that they might send to you at the end of each quarter. And if you're anything like me, or a real estate investor who's paying attention to the money that's coming in annually or quarterly from their investment property, with your retirement account, you're looking at your return. And if something is consistently not performing well, we don't think twice about moving money from Fund A to Fund B. And because it's all within our retirement account, it's all tax deferred. Well, 1031 is the way to do that for real estate, and many investors just don't understand it. They don't even know that it's out there, and that's why they need someone like you to tell them about it. This is not a new strategy. It's been part of the tax code since 1921. So for 105 years, this tax strategy has been out there, and it's always been designed to encourage people to reinvest. So let's talk about some of the rules around how much you need to reinvest, but also what taxes are due when we sell a property, because I think that's really important. I've done a number of presentations with someone that is a financial advisor. And one of the things that he has said that has stuck out with me is I want to learn as much as I can so that I could put myself into the shoes of my client. Because if I can do that, I can be a much better advisor, build a stronger, more valuable relationship that's a win-win for both of us. So when someone sells that property, they had to pay tax on the profit or the gain. And that's the difference between what they originally paid for the property plus any capital improvements they made to the property and what they're selling it for today. So if you are selling that property for $100,000 and let's say you paid $50,000 for it, then your gain is the $50,000 difference. It probably would have been better to not pick a number that would be 50,000 either way. But that $50,000 of gain is what you would have to pay taxes on. If you held the property for less than 12 months, a lot of people don't realize that they don't pay capital gains on that. They pay ordinary income taxes, which could be as high as 37%. So a huge, huge number. And the capital gains tax rates kick in if they've held the property for at least 12 months. And those capital gain tax rates are 15 or 20%, depending on how much income they have. And that 15 to 20% doesn't mean everything is taxed at one or the other. They're going to hit certain thresholds. So once they hit a certain number, then everything is taxed at 15%. Once they've reached that threshold, anything above that is going to be taxed at 20%. So that's our first federal tax. The second federal tax that we have to worry about is the net investment income tax. And that actually applies to every single one of us every single year because we're all individuals. But it applies to individuals, estates, or trusts with a modified gross annual income of just $200,000 if you're single, $250,000 if you're married, filing jointly. But that would include your salary, your commissions, all of your passive investment like rental income, capital gains, dividends, interest, things like that. And what it is, it's a 3.8% surcharge on all of that unearned income. So capital gains, interest, dividends, and rental income. So a lot of people are unfamiliar with this tax that went into effect in 2013. And the third federal tax we have to worry about when we sell is if it was held for business use or investment, we took depreciation. And we all love depreciation because we get to write off a little piece of the value of our building every year for 27 and a half years if it's a residential property or 39 years if it's a commercial property. And when we say write it off, it means it gives us a credit and we could use that credit against taxes that are due. And it's really designed to help you for the wear and tear associated with your building. But what a lot of people don't realize is that when you sell that building, you have to recapture or pay back up to 25% of the depreciation you've taken. So that number in some situations is actually higher than the capital gain taxes that are due. We're going to go through an example in just a few minutes. But now on the state side, all states are not created equal. Every state is a little bit different in how they tax. Pennsylvania has a flat income tax. So we pay a 3.07% flat tax on all of our income. And that has not changed in quite a while. Honestly, I can't remember not saying 3.07%. New Jersey, you're so close to New Jersey and you could very likely be working with a New Jersey taxpayer, or maybe you have property at the Jersey Shore or in Lambertville or somewhere that you have a rental property there. But New Jersey has their tax is based on your income and it ranges from 1.4 to 10.75%. Delaware goes up to 6.6%, and I listed some of the most local states to us, but I also added Florida. Florida has no income tax, so that's why a lot of people relocate to Florida. So there are the different taxes that are due when someone sells. Now, when you're completing a 1031 exchange, in order for you to maximize that tax deferral, you had to buy something else of equal or greater value, and you have to reinvest all the net equity. So if you remember my very first example, I said, if we sell for $100,000 and we have $30,000 owed to the bank and $70,000 of equity in that property, in the new property, we'd want to buy for at least $100,000 and put all of that $70,000 of equity into it. But you can deduct the closing cost. So if you sell for $100,000 and you have $5,000 of closing cost, then that means your new property, including closing costs, should equal at least $95,000. If from that $95,000 you pay off your $30,000 mortgage, now you're left with $65,000 of equity, and all of that equity should go into the new property. But you can trade down. A misconception is I can't buy for less. You can, you just have to pay tax on the difference. So in that situation, if I only bought for $65,000, then if I had to buy for $95,000, I traded down $30,000, which we can't figure out if that makes the most sense for them. Only they can do that with the help of their tax advisor. But unless their tax basis is more than that 60,000, there's probably not a lot of tax benefits to do that, to do an exchange. And that's where your 1031 exchange qualified intermediary really comes into play, because we can ask some of those questions. We can't tell them exactly what to do, but we can raise the red flag and say, oh, if you're going to take that much equity out of it and not reinvest it, it may not provide the tax benefits to you. But a lot of times it does. I worked with a Princeton taxpayer who sold farmland to Toll Brothers, and he was like many other farmers, and he was land rich and cash poor. So the first thing he did was he took $1 million and he put it in his pocket, and he did a 1031 exchange on $9 million. But in his situation, it was almost all gain because his father gifted that land to him decades ago. And it provided a great tax strategy for him, even though he traded down. We call that trade down, the portion that you have to pay tax on, we call it boot, just like you might wear on your foot. Not on a hot day like today, but in the winter months. Now, one of the things that I always tell people, if you want to take money out of your 1031 exchange and not reinvest everything, do you really need the money right now? Because one of the things a lot of people forget about is that after you complete an exchange, you can refinance. So if you could complete your exchange, reinvest everything, buy your replacement property, defer all the gain, then you can go to the bank and refinance, and that will give you the ability to have your cake and eat it too. So now that we talked about the tax consequences, let's talk about some of those non-tax benefits of doing a 1031 exchange. So we have immediate tax deferral. So rather than paying the tax, we get to take that money and we reinvest it. So that money is still working for us, and that will continue to appreciate for us. So we are just keeping that money working for us and buying the next property with pre-tax dollars. We have the ability to buy something that's going to create greater cash flow for us. Maybe it has more units. If it's in a resort area, maybe it's in a better location. Maybe it has, it's just in a different area where you can collect higher rents. Maybe it is what you have is vacant land that doesn't generate any cash flow. And you finally decide, you know what? We are never going to build our dream home there. Let's just exchange that into something that will generate cash flow for us. It's a way to diversify the type of asset you have or the location of that property, and it's a way to consolidate. I recently worked with someone who had 146 single-family homes in North and West Philadelphia. He sold it as one package to one buyer, and he bought one replacement property. And he said to me, Margo, I honestly have no idea what I'm going to do with my time. My entire adult life, all I've done was manage these properties. So think about life changing to go from 46 doors, 146 doors, to one replacement property that's passive. And you don't have to do anything except make sure the money hit your bank account that month. Is also the way um, to we talked about selling 146 to buy one, but I've seen it go the other way as well. So keep in mind that while there are rules about what you can identify, it doesn't mean you can't make some of these things happen. It just takes a little bit of planning, and that's when a good qualified intermediary and someone that like yourself who has a basic understanding of 1031, who can introduce the idea to their client, we can make all of this happen. A 1031 exchange is also a great strategy for a business owner who owns real estate associated with the business. When he's ready to retire, then he can sell that real estate to the new business owner and he can exchange that for some type of income producing replacement property. It may or may not be passive, but it's going to help pay for their retirement. For that business owner, it's also a great way to relocate their business, to expand into multiple locations. So, a lot of different opportunities for business owners. And one of the things that I said was a 1031 exchange works on any kind of property held for business use or investment. So, a couple of things that aren't held for business use or investment is your primary residence or your vacation home. So, on the surface, they do not qualify for 1031 treatment. However, after using a rental property as a rental for 2 years, there is a revenue procedure that safely allows you to convert that into a second home or a primary residence. So maybe you have something locally, right? Maybe it's in Yardley, it's a nice rental that you've had for a number of years, and you decide, you know what, a few years from now, I want to become a snowbird. So you complete a 1031 exchange and you sell your Yardley rental and you buy a rental condo in Naples, Florida. And for the next couple of years, you rent it all the time. But now you are older and you are ready to spend some of the cold months in Florida because nobody likes January and February in Pennsylvania anymore. So you could actually convert that property in Florida into your second home and spend some of your time here and some of your time there. When you do that conversion, it does not automatically trigger tax. As long as you own that property, the tax is not due. If you, and that would be whether you want to make it your primary residence or a vacation home. The key is 2 solid years, and it's 2 years from the day you bought the property. So it's not based on calendar years, but actual, I bought it today, August 13th, 2026. So for the next 1 year, I'm going to rent it. I'm going to minimize my personal use to just 14 days out of the year. And then from August 13th of 2027 to August 13th of 2028, we're going to do the same thing. But then after that, I could use it for personal use. Now, if you decide to sell that property 20 years from now and you've been using it as a second home, well, then we're going to have to plan to figure out, okay, how do we minimize the tax consequences there? But as long as you own the property, there is no tax due. There is no tax due when you convert it from an investment property or a business use property to a personal use property. Another thing is, if it's an investment property, you can exchange again. So you could do an exchange in 26, and then maybe you find that the house in Ocean City, Maryland, that you have been eyeing, it's your favorite house, all of a sudden it's on the market. Well, maybe you want to exchange into that. So you can do that. And again, you just keep postponing your tax. It's all deferred. It's still in that property. So you're simply shifting it from the Yardley property to the Florida property to now the Ocean City, Maryland property. And that's how you're building your real estate portfolio with pre-tax dollars. Now, somewhere down the road, if you decide to do an outright sale and not exchange again, that is when that tax will come due. But if you never do an outright sale, you continue to hold those properties down the road, when someone passes away, their heirs inherit that property with a step up in basis. So a step up in basis means they inherit it at the value on the date of death. So if you defer $2 million during your lifetime using 1031 exchanges, and then your estate inherits that property, all the gain that you deferred using 1031 all goes away, and they inherit the property at the current fair market value. So they can decide, you know what, that was mom's property. She enjoyed it, but that's not really what I want. They can sell that and likely have no capital gain taxes. they would only pay taxes on the difference between what the value was on the date of death and the date they sell it. So it could be nothing. If they hold it for 5 years, then of course there's likely to be some gain. And on the federal side, the first $15 million of someone's estate is exempt from estate taxes. So I know I sound like a broken record when I said this is a great way to build wealth, preserve your equity. But the next step is you could pass that to the next generation without any federal taxes. So it's a really powerful way to build wealth. Alrighty, so now we talked about all the tax consequences, the tax benefits, as well as the non-tax benefits. So let's talk a little bit about the rules. Well, when you do an exchange, this is actually a great illustration because it just outlines the way everything works. There are a couple of timelines that start the day you go to closing to sell your old property. From the day you sell, you have two timelines that start clicking. The first is your 45-day identification period, and the second, running concurrently based on calendar days, not business days, is your 180-day exchange period. In the first 45 days, by midnight of that 45th day, you have to send a letter to your qualified intermediary listing property you're interested in purchasing. And the qualified intermediary is an independent party who serves as your middleman, whose job is really to coordinate all the details of your exchange. When you do an exchange, at the closing, you don't walk away with any cash. What happens is the closing agent will send those funds to an account set up on your behalf by the qualified intermediary. So those funds are wired to a bank account established by the qualified intermediary. I can tell you that 1031 Corp sets it up with the name of our exchanger and their social security number or their EIN number attached to it. And that's like a direct deposit for the replacement property. It's sitting in that account waiting for them to need an earnest money deposit or buy their desired replacement property. So once they do, the qualified intermediary will send all of those funds to the closing agent for the purchase of the replacement property. But in the first 45 days, they have to tell the qualified intermediary what they're interested in purchasing. They don't need to have the property, they don't need to have the property under contract at the time, but let's be realistic. It's still a very challenging real estate market. And if somebody were to list 3 properties in an identification and send it over to me by midnight tonight, which happens to be their 45th day, are any of you confident that if none of them are under contract, that you would be able to get one of them? I think most of you would say no. So my suggestion is always to try to get something under contract in those first 45 days. And our data, our 1031 Corp data shows that that is what our clients are doing. They're working with their real estate professionals and they are lining up those properties sometimes before closing or immediately after closing on the old property. Because when I look at the last 90 days, the exchanges that closed were only open for an average of 62 days. So that means that, like I said, they've got everything lined up. And it makes sense because nobody wants to sell a property that they know how it's performing until they know what they can buy to replace it with and know that it will perform better for them. So my advice to you as the real estate professional is you could be the hero in all of this. Bring up the idea of a 1031 exchange right when you're taking that listing agreement, because you'll know it's a rental for them or their business uses the property. You'll know it's not their primary residence. So bring up the idea of a 1031 exchange. Encourage them to talk to their tax advisor. You can give them a little bit of information on 1031 exchanges. You could give them my phone number. You can prepare your own fact sheet. But at least put the bug in their ear. And the earlier you do that, the better. If you talk about it right when you're taking the listing, what you're doing is you are demonstrating, hey, I'm not just trying to sell your property. I'm not transaction focused. What I'm really trying to do is help you. I want to help your financial wellness, right? I want to make sure that you know this is a strategy that's available to you. So by midnight of the 45th day, they're going to send over a list of properties they're interested in purchasing. The rules say they can identify up to 3 regardless of their combined fair market value. But if they identify 4 or more, all 4 or more together can't equal more than 200% or twice the value of the old property. So if we go back to that same example we've talked about, where we sell for $100,000 and they want to identify 3, those 3 could equal $20 trillion if they wanted. But if they wanted to identify 4 or more, we're locked into a 200% value rule. And the 200% value rule says you have to take your old property, times it by 2, and that's your cap. So if we sold for 100,000, we're capped at 200,000 if we want to identify 4 or more. If we want to identify 1, 2, or 3, the sky is the limit. There is no cap. But we see both of those rules work very successfully for exchangers. The next timeline is that 180-day exchange period. And remember, it's running at the same time. And they have 180 days to wrap up the exchange and buy whatever it is they want to buy and use all of their funds to do that. So let's move on and talk about like kind and what that means. And you've probably all heard 1031 exchange referred to as a like kind exchange. That's their official name. The tax form says it. If you look it up on the IRS website, it's called a like-kind exchange. But the term like-kind actually causes a lot of confusion. Like-kind actually has nothing to do with the kind of property it is. What makes a property like-kind is its use. So any property held for business use or investment can be exchanged for any other kind of property held for business use or investment. So I included a couple of different types of properties, whether it's a single family home, maybe it's a single family home or a condo in a resort area that's used as a rental. It could be farmland. It could be a conservation easement. It could be a cell tower easement. It could be an office building, a shopping center, really just about anything you can think of. And when we talk about like kind, that means residential can be exchanged for commercial, commercial could be exchanged for residential, and it can be anywhere in the US and most of our US territories, which is what makes like kind so flexible. You can mix and match any kind of properties. So really, the opportunities are endless. What makes properties like kind, right, is really the use. We just talked about that. I do want to just take a step back and talk about like kind for one more second and note what will not work. What will not work is a personal use property, such as your primary residence or a true vacation home that has never been rented. But if you have a true vacation home that's never been rented, let's say you happen to have one, and it's in Avalon or Stone Harbor, and you bought it in 1984 for $155,000. Did I mention it's on the beach block? Because now it's worth 8 million, 10 million, even if you never tore it down. I think you may have all seen a couple of years ago in the Philadelphia Inquirer and the Philadelphia Business Journal, there was that really cute little teal cottage that sold, I think it was in Stone Harbor for $10 million. They never did a tear down, but the location was desired, very desirable. So they were able to sell for $10 million. And because their property was always a rental, it was a non-issue. But if you happen to have that property that's worth $10 million and it's never been rented. Well, then you have to pay the tax on all of that gain. There's no way around that. But you can get creative and convert it into a rental property for 12-month periods. And then all of a sudden, it qualifies for 1031 treatment. Again, you have to minimize your personal use. You can't use it more than 14 days out of the year, or 10% the number of days rented. But if your gain is millions of dollars, it would be worth not using it for 2 years so that you could defer that gain. And then you can buy any kind of property. You don't have to buy another resort area rental. You can buy a triple net lease property. You can buy an office building. You can buy a shopping center. So really lots of opportunities. But a true vacation home that has never been rented does not qualify. And your primary residence that you live in does not qualify either. That's a personal use property. But when you sell your primary residence, if you've lived in the property for more than 2 years, so more than 730 days over the last 5 years, when you sell, Section 121 of the tax code gives you the ability to exclude up to $250,000 of gain, or $500,000 if you're married filing jointly. And an exclusion is way better than a deferral under 1031, because an exclusion means this is your money, you don't have to pay any taxes on it. Now, the thresholds are really low, and there is a bill that's been introduced into Congress to double those amounts. And I'm sure you're reading all about it through your NAR updates. And hopefully that is something that will get passed, and it will help longtime homeowners, but it will also help free up inventory as well. So personal use property does not work for 1031, nor does a property held for sale. So a property held for sale would include something like a flip or a spec home that you're building, or if you have building lots, those properties are really inventory for you and not eligible for 1031 treatment. So just wanted to touch on that before I moved on to qualified use. And I've already touched on that bottom one. Section 280A of the tax code says if you're in a resort area, you can use the property for up to 14 days out of the year, or 10% the number of days rented, whichever is greater. But everyone always says, Margo, how long do I have to hold this property before it qualifies for 1031 treatment? And there is no, this is absolutely the time limit rule. Intent is much more important than the length of time. 1 to 2 years is a good rule of thumb, but I can tell you that I've done exchanges for people where it's much less than 1 year. And that's when their tax advisor and their legal advisors look at that and think, okay, they bought this property, they had every intention of holding it. They had tenants in it nonstop, and all of a sudden they get the unsolicited knock on the door and a crazy offer to buy that property after 5 months. If you have the opportunity to make a couple $100,000 in a couple of months, you might not want to say, hey, could you come back in 7 months? You might want to push the closing back a little bit, but if the intent was there and you were doing everything 1031 is designed to do, and you plan to exchange it for another property that you're going to hold for long term, then why shouldn't you be able to do that? So just throwing that out there. And let's talk about that qualified intermediary again. That's the role that I play, or 1031 Corp plays in a transaction. As a qualified intermediary, we are an independent party. Within the last 2 years, we cannot have acted as that exchanger's real estate professional, attorney, accountant, or financial advisor. We cannot be a close relative, an employer, or partner. So we are truly an independent party. As the qualified intermediary, our job is to prepare the necessary exchange documentation. We're going to coordinate with the closing agents on the sales side as well as the purchase side. We're going to keep our exchanger aware of all of the timelines and make sure that they can meet all of those. The other thing we do, we mentioned earlier, is we control the sale proceeds. But as I mentioned, we put those funds into an exchange account with their name and their taxpayer identification number on it. They can log on to the bank website, they can see their account balance, they can earn interest, but that money should only be used to acquire the replacement property. So they can't just call and say, "Hey, Margo, I want to buy a new car. I need some money." That money is only for the purchase of the replacement property. If they decide not to identify by the end of day 45, then on day 46, those funds are released to them. If they identify a number of properties and then decide they don't want to buy them, unfortunately, I have to hold those funds until the end of the 180-day exchange period, and then I can release the funds to them. But the qualified intermediary is there to guide them through every step of the transaction, help them anticipate what's next, and keep this an easy process for them and for you as well. We've already touched on they can have actual or constructive rights to the sale proceeds, and we just talked about when they can be released. One of the things people always ask is, Margo, when should we set up the 1031 exchange? Well, I always tell everyone to call anytime you have questions. I talk to some people for years before they actually pull the trigger. But once they have a signed agreement of sale, that's the time to initiate the exchange because there's a title company or a closing attorney somewhere who is starting to prepare for that transfer of ownership. So we want to give them the notice as quickly as we can. We can do that all the way up to they're sitting at the closing table. And we all know, we all agree right now, that's not the preferred way to do it. But let's say that you mentioned to your client, so I see Nancy on here. So let's say that Nancy mentioned to her client when she took the listing, and the client said, "No, I don't want to do that." And let's say when it came time to put it under contract, Nancy said, "Hey, do you want to talk about the 1031 exchange? Are you interested in buying another property?" "I don't think so." And then here it is, we're walking into closing, and your seller says, "Nancy, I talked to my CPA last night, and he told me I'm gonna have to pay $70,000 in taxes. Can I still do that 1031 exchange?" Yes, you can. Even if they bring it up while you're literally sitting at the table. Yes. But if you're walking out to the car after closing and you tell your seller, keep your eye out, you should get a notice from your bank that that wire hit. And they say, "Oh gosh, Nancy, I forgot to tell you I need to do that 1031 because I have a big tax bill." It's too late. Now they're in control of the funds. So we can do it all the way up to sitting at the closing table, but once closing's over, there's no opportunity for an exchange. And the next requirement that I wanted to share with you, it's the same taxpayer, same owner. So whoever owns the old property, and you're all doing your due diligence when you're putting together your listing agreement, whoever is listed as the owner is the one that has to buy the new property because they've been filing a tax return and including this property. So that taxpayer has the tax bill associated with the property. So we need the same taxpayer or owner to buy the new property so they can tell IRS on one form that they sold a property and they replaced it with this one. If they want to create a disregarded entity for tax purposes, they can do that, such as a single member LLC, as long as the sole member is the same taxpayer that sold the old property. So that is all the rules, but I want to go through just a really typical scenario quickly for you. So John owns a single family rental. John's owned it for 15 years. He originally paid $350,000. He's made no improvements over the last 15 years, but he did take $150,000 of depreciation. And now he's going to sell it for $600,000. So he's like really conflicted. I want to buy a shore rental, but I really want multifamily. What do I do? So he's out there looking for all these different things. He's got no debt. So this is how it shapes up for John. John is an individual taxpayer, so just some background that's important to know. He's in the 15% capital gain tax bracket. His gain on that property that he sold for 600,000, if he paid 350 for it, his gain is $250,000. So he's going to be subject to the 3.8% net investment income tax because as an individual, he only needs to have at least $200,000 of income to fall into that. So he's there. And he's got $150,000 of depreciation that has to be recaptured at 25%. So this is how John's sale shapes up. John sells for $600,000. He has $250,000 a gain. At 15% capital gains, he's going to pay $37,500 in capital gains. I did an estimated state income tax of 5%, right? If you're selling in New Jersey, it's going to be higher. Pennsylvania is slightly less. But at 5% on $250,000 of gain, it's $12,500. And it took, we also had to remember that 3.8% net investment income tax on the $250,000 of gain is another $9,500. And last but not least, we have to recapture or pay back the $150,000 of depreciation we've taken at 25%. So that's another $37,500 of tax. So John's state and federal tax liability is $97,000. So that's why when you reach out to investors and you're doing your farming and they're like, no, 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 that's because the Johns out there look at numbers like this, talk to their tax advisor and say, no way, I'm not selling for $600,000, paying $97,000 in tax. Then I only have, $500,000 to reinvest and I really want to buy that multifamily or that shore place, whichever it is. If he took that and he leveraged it as a 30% down payment, he could go buy for $1.67 million. But if John knew about 1031, John didn't have to pay that $97,000 of tax and he gets to reinvest all of it. So he takes his $600,000 and he uses that as a 30% down payment. And yes, he could do a 20% down payment, but at 30% down, he could go buy for $600,000 or $2 million. Now, I do want to note that I didn't include closing costs just to keep nice, easy round numbers. It's hard when we're doing all of these, so it's just trying to keep it easy. But John was able to immediately avoid $97,000 of federal tax. More importantly, he leveraged that to buy something that was $330,000 more expensive than he could have bought if he didn't do a 1031 exchange. So with that higher priced property, whether John really leveraged up or he just took his $503,000 and bought another property, that higher priced property is likely going to collect higher rents from day one. He'll have more depreciation available moving forward and long-term likely have greater appreciation. And you help John avoid that $97,000 tax bill by bringing it up at the listing, and you're the hero. And he's going to tell everybody how you helped him. So when you do a 1031 exchange, like just one little technical piece of this, remember we talked about at the very beginning, everything from property A shifts over to property B. So whatever John's basis was in his old property shifts over to the new property. Now, he bought something that was more expensive, so the basis will increase by that same amount. And John will continue on his old depreciation schedule for the first $600,000. And then the new increase in property value, he'll start depreciating as a brand new asset. So that was probably the most technical thing. I threw a couple of other cases in here that I thought I hid from you, but I want to get to the end. So I'm going to end my slideshow, and then I'm just going to go further back because I want to be mindful of the time. But I'm going to send you this with information on reverse exchanges and also on Delaware statutory trust. And I'll talk about the Delaware statutory trust for Oh, I think I showed you the wrong. I missed a couple of slides in here. Putting them in here. I think I just worked on editing my slides and I grabbed the wrong one. But let me go to this last slide with all of my contact info. And let me just talk about a couple of things quickly. When you have a client and they're thinking about doing an exchange, bring you don't have to know everything. You just have to know the basics. So what you can do is one, if you want to learn more, go to realtor.org and search 1031. They have a wealth of resources for you right there available to you. The next thing is I can help you. If you're interested, you're going to get all of my contact. You see my email address, Margo at 1031 Corp. Send me an email that says flyer with all your contact information, and I will put together just a one pager on 1031 exchanges. 1031 made easy, and right there on the bottom section here, it will have all your contact information, your email, your company name, your logo, all of that stuff. You don't have to know everything. That's where we can help you. If you have a question and you're meeting with someone tomorrow and you know, hey, they're listing this farmland that they've owned for a really long time. I know they had to have a gain. Margo, give me some talking points. What can or should I bring up? What are some tips that you could give me to get this listing? I'm happy to brainstorm things like that with you. If you have a number of investors that you think might be interested in learning more about 1031 exchanges, well, let's set up a conference call or I'll come out and meet with you and your clients. We're here as a resource for you. Again, you don't have to know all the rules, but know how to recognize the opportunity. And I would say the easiest way to do that is taking a listing in which the seller does not live in the property. Unless it's a farm or a duplex and they live in just a portion of it, because they can take their primary residence exclusion on a portion of it and they can 1031 the investment portion of it. So just keep that in mind. But this is a great way for you to add value in every transaction that you do with your clients. Someone described a 1031 exchange like this to me at my very first 1031 conference in 1995, all those years ago. And they said a 1031 exchange is like an interest-free loan from the IRS. You can increase the principal by doing additional exchanges, and if you plan properly, you'll never repay it. Just think about what a powerful sales tool that is for you. Alrighty, so let's go to some of these questions that are in the chat. And Lisa, can everybody unmute themselves if they wanted to ask a question?
Absolutely.
Okay. Alrighty.
Just hit the record, just hit the photo of it looks like a microphone at the bottom of your screen. And
perfect. So one of the questions that someone asked, what is really taxed by IRS equity? Equity has nothing to do with your gain. So one of the biggest misconceptions is, hey, I owe everything to the bank. IRS doesn't care. IRS wants you to pay tax on your profit. So if you paid $10 for something and you sell it for $100, IRS wants you to pay tax on the $90 in between. It doesn't matter. You could owe the bank $200 on it. IRS wants their piece of the $90,000 of profit that you have. So it's always based on your gain, not on what your equity is. You will get the recording of this as well as my slides.
Margo, I need to speak to our CEO. We no longer give out the slides. So
okay.
is it possible that they can email you if they want the slides? Is
Absolutely.
that
They can
okay?
see my
We don't do
email
that
right
as a
there.
matter.
Just
Okay.
send me an email that says BCAR slides, and I will get them right over to you. And this works for residential or commercial properties. The big misconception is this is only for big investors. You know what? The most frequently exchanged type of property in the US is a single family rental. That's something, right? For a lot of people outside their retirement account, that single family rental is their biggest investment. How would it work if you buy a new home to your primary residence? Want to retain the first property to be rental income. So there was a question, Stacy, I'm not sure that I completely understand your question. How would it work? So if you have a primary residence, you can move out of it, make the old one a rental, and then you can refinance it, whatever you want to do, and buy another property to use as your primary, but there's no 1031 in there. Down the road, if you sell the one that's now a rental, then you can 1031 it. If I didn't understand that, please chime in or email me. So you don't have to reside in the home during the 2 years as your primary. I don't understand. I think it's still Stacy. I just don't understand your question. I'm sorry.
That's okay.
Um,
Can you hear me, Margo? I took
oh,
myself off mute.
yes, yes.
Okay, so thank you so much for answering my questions. The first one, it was just my misunderstanding, I suppose. The second one, though, you were talking about needing to have held the property for 2 years. You don't
Mhm.
need to have resided in the property for 2 years.
You do. You have to have used it as your primary under section 121. So 121 of the tax code for the sale of a primary residence and that exclusion of gain, you have to own the property and use it as your primary residence for at least 730 days over the last 5 years. It doesn't have to be contiguous days, right? It's just any 730 days. In order to take that $250,000 exclusion if you're single, 500,000 if you're married, filing jointly.
Okay, and so that, I guess, again, I'm misunderstanding. That really has nothing to do with rolling this over as a 1031 to
No,
like
with your
then use
own,
that property for an income, a long-term investment property. I guess
right.
that's kind of tied
If
into my
it's your
first question.
primary, right, that gain, the up to $500,000 a gain that's excluded, that's your money. You could do anything you want with it. If you decide that you want to put some of it towards a new primary residence and some towards an investment property, and maybe some for a trip to Paris, totally up to you. But it's when you eventually sell a potential rental property, then you would, if you sold a rental, then that's when a 1031 exchange might come into play.
Okay, that was my own misunderstanding. Thank you for clarifying.
Oh, you're welcome. You're welcome. Um, and a typical exchange is just $1,250. So, I saw a question about reverse exchanges. A reverse exchange is a strategy that is used when, for whatever reason, your buyer you don't have a buyer yet, or the buyer can't close yet, and you have to purchase the replacement property or you're going to lose it. So, what happens in that situation is our company can create a brand new special purpose entity and take title to your new property or park title for up to 180 days, giving you time to sell your old property to a buyer and then take title to the property that we're parking on your behalf. So I always tell people it should be a last resort, especially in Pennsylvania, because we have to worry about double realty transfer taxes in PA. So unless the gain is, $100,000, I'm usually the first to talk you out of doing a reverse exchange. It's really important to talk to your tax advisor, know what the tax liability actually is before going down that path. But we have a whole team here that does nothing but reverse exchanges every day. It's a great strategy when it's the only one that will work. Maybe you had your buyer. I had this not too long ago. There was a buyer all set up. They were scheduled to go to closing. The replacement property was all set up, and the closing kept getting delayed for the old property because of the lender. And all of a sudden, it was the day of closing there of the replacement property, and there was no way they were going to close on the relinquished property. And we jumped through a lot of hoops, but we were able to structure that as a reverse exchange. Now, in that situation, the investor told me that his gain, it was actually a business use property for their corporation, but their gain was over $400,000. So it made a lot of sense to do that. But if you had said, hey, Margo, I've got a $20,000 gain, I would tell you, hey, it's better to just pay that tax. I never want someone to do an exchange and not get the tax benefits that they should get out of it. I only want you to do it if it makes sense for you. I think that I have all of the questions. You have my phone number, you have my email address. Feel free to reach out. I am always, email is always a great way to reach me. You might get an email back at 10 p.m. I'm sure you guys are doing the same exact thing I am, right? You're trying to get everything done. But I'm always happy to help. And like I said, I'm happy to brainstorm ideas. I'm working with a couple of real estate professionals at the Jersey Shore, and we're planning an investor seminar. Like they're like, do you think we could get 10 people? I'm like, I think we could get 30 people, like whatever. But we're brainstorming that together, and we're using our joint resources to promote that. And I'm happy to do things like that with all of you. And Lisa will tell you that we do occasionally do 1031 classes at
Yep.
BCAR. So I've done it many times there.
Yeah, we're planning our schedule now, so I might be in touch for the 2027.
So I know, I get it. Everyone just got their CE hours. No
I
one's in a
know.
rush to do that anytime soon. I get it.
Yeah, we are offering a few in the fall, but they're
Okay.
mostly like the required ones.
Right.
But
Exactly.
well, thank you so much, Margo. This was fantastic. As we mentioned, everybody will be getting the video in the middle of next week. And please reach out to Margo. And again, we appreciate all that you've done for our association, Margo.
Of course. And again, if you want the slides, just email me and say slides, and I'll get them right over to you.
Thank you. This was fantastic.
You're
We'll be
welcome.
in touch.
Well, enjoy the rest of your summer,
You
everyone.
too, everyone. Thanks.
Bye bye.
Bye-bye.